liquidity of our business to pay back short-term debts. So if you have short-term debts, are you going to manage to pay them back? Okay. So the first liquidity ratio is the current ratio. So current ratio is calculated as current assets over current liabilities. Current assets over current liabilities. So the ratio basically it intends to measure the company's ability to meet short-term obligations using short-term assets. So the short-term assets like inventory, receivables, cash, are they going to manage settling our short-term obligations like payables, short-term loans, overdrafts? That's the current ratio. So basically, the rule is that current assets should at least exceed current liabilities by 1.5 times. Then acid test ratio is the same as current ratio, but we say if we remove inventory from our assets, are we going to still remain liquid? So it's current assets minus inventory over current liabilities. So it only focuses on what? The liquid assets. So the same as the current ratio. So the target in books, they say at least the answer should be 0.8 above. Current assets should exceed current liabilities by 0.8 times. Okay. Then now let's appreciate efficiency ratios as well as solvency. Efficiency ratios, they say they look at the efficiency of a business in managing its operating cycle. The efficiency of a business in managing its operating cycle. So the first efficiency ratio is the receivables collection period. So the receivables collection period is calculated as receivables over credit sales times 365 days. So it looks at how long does our business take to collect cash from customers. So once we sell on credit, how long do we take to collect the cash? Then we have the payables payment period. This ratio looks at how long do we take to pay our suppliers. So it's calculated as payables over purchases times 365 days. If you are not given purchases, you use cost of sales. Inventory holding period. This one looks at how long do we hold inventory before we sell it. The number of days that we hold inventory before after selling it. So it's calculated as inventory over cost of sales times 365 days. So those are efficiency. Some books will also call those as liquidity ratios in addition to current and quick. Then we have the long-term solvency ratios. They also call them as gearing ratios. These ratios, they aim to expand on liquidity. Liquidity looks at how soon can we pay short-term debts, while the long-term solvency ratio looks at how soon can we pay long-term debts. In simple terms, are we going to manage to pay long-term debts when they fall due? So we have got three ratios here. Debt to equity ratio, which is calculated as debt over equity times 100%. Debt over equity times 100%. So debt, we are talking about issues like bank loans, bank overdrafts, they can be within that. But we focus mostly on long-term debts. Okay, so it basically means proportion of debt to equity financing. So when a company has got a high proportion of debt, it is deemed to fail. Gearing ratio is the advanced version of debt to equity ratio. It says the total capital of the business is comprised of debt and equity. Therefore, out of the total capital of the business, how much is debt? So it's debt over debt plus equity times 100. So we try to assess financial risks and dependency on debt. So how risky is the business and how dependent are you on debt? Then we have the interest cover. Interest cover looks at the ability of our business to service debt obligations from profit. So the profit that we have, are we going to manage to pay interest on those profits? That's the interest cover. So it's calculated as operating profit over interest paid. Then we have finally shareholders investment ratios. So shareholders investment ratios are ratios which attract investors in our company. So they include earnings per share, price earnings ratio, earnings yield, dividend cover, and dividend yield. So let's start with earnings per share. This one is calculated as profit after tax over number of shares. Or some books will say profit attributable to ordinary shareholders over number of shares. So the ratio shows how much profit is earned per share. Then price earnings ratio. Okay, before price earnings ratio, let's look at the price earnings ratio. I think that one should look at first. So earnings per share, I've said it indicates how much profit we earn per share, while the price earnings ratio is calculated as market price per share over earnings per share. So this ratio, it reflects how much investors are willing to pay for each unit of earnings. So it actually means if our price of the share is 10 kwacha, are investors willing to buy the shares at 10 kwacha, for instance? That's what the price earnings ratio looks at. Then the earnings yield is the opposite of price earnings ratio, or it's the converse. You turn the formula around. The previous one was market price per share over earnings per share. Now it will be earnings per share over market price per share times 100, because now it is a yield. So this ratio shows a return on share price in terms of earnings. So how much is our earnings as a proportion of market price? Then dividend cover. Remember the main goal of financial management is to maximize return through payment of dividends. So we're trying to look at, out of the dividends that we have, or out of the profits that we have, are we going to manage to pay dividends? Now, if we manage to pay dividends, are we safe as a company? So they indicate margin of safety for dividends. Are we going to continue paying dividends? If we pay dividends, is our company going to survive? So calculated as profit after tax over dividends paid. Finally, dividend yield. So dividend yield basically looks at the proportion of dividends to our market price. So it's dividend per share over market price per share times 100. Or you can say total dividends over total market price times 100. So basically, it means the income returned to investors from holding the share relative to market price, or by paying dividends. Because we are paying dividends to these shareholders, how much is the proportion of the dividends to the market price? Okay, do you have a question?
Oh, I don't have.
Okay, so that is part 1. Today we will not practice a question.
Okay.
We'll practice later on tomorrow. Let's move on to, so that's the end of ratios. Let's now move on to not-for-profit organizations. Just a summary, because we'll cover this later on. So not-for-profit organizations are those organizations which don't trade for profit, right? So their objectives include service provision, not profit. They are not there to achieve profit, but they're just there to provide services. And they also focus on public interest as well as welfare. So they are there to ensure that people are happy and the welfare of the society is at heart. Now, to ensure that we perform in not-for-profit organizations, there are three issues we consider. We consider economy, efficiency, and effectiveness. People call them as value for money. So economy is there to minimize cost. So let's minimize cost as far as we can. Efficiency is there to maximize output from the resources that we have. Then effectiveness is there to achieve the intended outcome. So from the resources that we have, let's achieve the intended outcomes. Okay.